Hello everyone. Today me, Jeremy and James are going to talk about chapter 5, finance needs and sources. So first of all, what is finance? Finance is money needed by the business to set up, expand and run the business. So there's three types of capital. Startup capital, which is the money needed by the business to start up the business. Second is working capital, which is money needed to run the business, like production costs, maintenance costs, etc. Third is capital expenditure, which is money needed to expand the business, like the land, machines, equipment, etc. So there's two types of source of finance. There is internal finance and external finance. So starting with the internal finance, we have retained profit, which is profit that is kept by the business after the owner took it. This is good because we can get immediate money for anything emergency, but it's limited. And then second is sales of existing assets, which is assets we have like land, machines, equipment. We can use that to sell and get money, which is, but the disadvantages is that it takes long time to sell. Third is sales of inventory, which is your goods and the things that you don't need. It's good, but maybe if your inventory or your product has skyrocketed in demand, it's hard to keep up the production rate. So, and fourth is owner saving. Well, the money owned by the owner for the business, it's bad if it's partnership because your money can be taken by your friend. Okay. And now we're going to external finance, which is issues of share. This is only for limited companies where they sell their shares. It's good because you can get permanent money, but if it's too much shares, the shareholders can take over the business. Second is bank loans. There is short and long term. For short term, it's small amount of money, but the interest rate is higher because most people use short. And there's second is long term, large sum of money, but the interest rate is not as high as short term. Second is debenture issues, same as issues of share, but it's agreement which is they buy our shares, but we pay them later. The disadvantages is just it has higher interest rates than issues of share. And then fourth, we have debt factoring, which is debt collectors collecting money that the other business have other debts with us. The disadvantages is we don't get all the money because some of the money is taken by the debt collectors. Fifth is grants and subsidies, which is money given by the government. It's good because you have free money, but the disadvantages is that it has some agreements that's changed the business model. And then six, we have microfinance, which is usually money borrowed online. You can borrow like a lot, small amount, but the problem here, it has the highest interest rate. And then seventh is crowdfunding, which is same as donations, but there's like a specific company where you will do the crowdfunding. For example, if you crowdfund $1,000 for your company in 3 months, if the crowdfunding in 3 months has not reached 1,000, maybe $500, the $500 will be kept by the crowdfunding company. So yeah, you will lose the $500. And then eighth is trade credit, which is for is a business buying supplies from the supplier, but they extend the payment. For example, in 2 months. But if you paid 1 month early, maybe you can get a discount. But if you paid like 3 months, 4 months more, you can get a penalty and a losing credit of the business. And last is leasing. Which leasing is it's using assets but not purchasing it. It's like borrowing, an assets. Yeah. And then last, we have factors affecting the choice of sources of finance. So these are the factors that the business thinks before they choose what source of finance they will use for the business. So first, the purpose. The purpose we use. Oh, okay. So the purpose is what will they use for expansion, for day-to-day runs, paying loans or debts. And then time, which is the longer time, so it could be higher interest rate. If short-term could be lower, you know. And you can, if you choose shorter term, you can borrow more. You can borrow more, but you'll pay more in a year, for example. And then the amount, the more amount of money that you needed, different things you will need. You know, maybe shares. Maybe you'll share the shares of the business for more money than bank loans because the interest rates are higher. And then legal form of size. This is according, if the business size is big, you can be a limited company, which is you can sell the shares. And then control. This is related to the legal form and size. You need to look at the shares. If the shares is too much bought by the shareholders, they could they can take over your business. And then last is risk of gearing, which is interest. So you need to look at the amount of money you borrow. If you borrow too much, the interest rate could be very high, and then you can run in debt, and then you lose profits just to pay off the debt. Yeah, that's all for me. Thank you.
So the second topic is about cash flow forecasting and working capital. What is cash flow? As we can see here, cash flow is cash flow inflow plus cash flow outflow divided by period of time. What is cash flow inflow? Cash inflow are the sums of money that are received by the business. The example is sales revenue, and there is debtor payment that are usually debtors are paid or purchased good from the business and didn't pay, or money borrowed like loans from the bank and something like that. Sales of assets, some of the or business have the asset and they sell the business to the other business. Investor is putting more money into the business. And then what is the cash outflow here? Cash flow outflow is the sums of money that are paid by the business over a period of time. The example is purchase goods, material. There is also paying wages and salaries to the employees. Also purchasing the fixed asset that they want to buy, repaying loans that are they borrow, and paying the creditors. So we can see here the cash flow cycle. The first one, the cycle is cash needed to pay for. And the second, what they need to pay? They need to pay the raw materials, wages, rent, and other bills. After that, they can have the producing of goods and service. And then they sold the good or service, and they receive the cash from the customer. And then we go here to the cash flow table. As we can see, cash flow forecast is the estimate for future cash inflow or cash outflow. And this is the cash flow forecast for the 4 months, from the August to September, October, and November, December. As we can see, there's from August, the opening balance is 100, and then the net cash inflow is 3,800, yeah, 3, and then the closing balance is 3,900. And then for the September, they are 3,900, and then 6,800 and 1,01700. So until this December, the cash flow forecast is recorded here. What is the function of the cash flow forecast or the table here? The function to the business are setting up the business. So the manager need to know the cash needed for setting up plan or something that they need. And then they need also this one for a statement of cash flow forecast, because it's required by the bank managers when they the business applies for loans, and then they need the cash flow forecast are managing the cash flow, because sometimes the cash flow are really hard to manage and can cause the bankruptcy for the business. So actually there is the opening and closing balance. The opening balance is the amount of cash held by the business at the start of the month. The closing balance is the close balance, or the amount of the amount of cash that held by the month over the next month. I think so. And then that's all.
Hello, my name is James Sebastian Halim, and welcome to the Zoom room. Welcome to the video. So today I'll be explaining about income statements, statement of financial position, and analysis of accounts. So about this, income statement is the statement of how much money is flowing into the business and how much money is actually gained by the business and retained by the business. Now you need to understand what profit is. Profit is the money retained and gained into the business after selling. Revenue is generally the money gained after selling, but we are talking about the money kept after selling, after all the costs has been paid. So the formulas in order to calculate that you're going to see in the income statement, here's the three things. All right. There's the gross profit, which is revenue, the money gained, after selling, minus the cost of selling, like the cost of actually distributing the products to other channels. And then profit is gross profit minus fixed costs. This minus this. We want to get it cleaner because this is the general profit. This is general. We want to get it cleaner. Alright? This is the thing that is going to be divided between the shareholders. And then we have retained profit. Retained profit is basically the profit minus the dividends and the expenses that we pay to our shareholders, suppliers, and every one of these people that need the money from the business, and that leaves the business owner with the money. And asset test ratio, which is current assets divided by current liability. This shows us how much money we actually have in order to pay off the shareholders, the dividends, and stuff like that. This is the current assets divided by current liability, the ratio between money and costs. Okay, over. Now we're going to talk about statement of financial position. So this statement of financial position is actually an account or a record or a document, of the business's financial stability. This means the businesses. It says here. Assets, liabilities, and owner's equity, which is basically the money gained from shareholders, and the financial stability of a business at a particular date. All right, at a particular date, so people can just check this stuff out. So the definitions. These are the definitions that we need to understand before going into all this. Assets is resources owned by the business, like the money, the building, the equipment, and actually not the employees, but the money, the equipment, the building, stuff owned by the business. Liabilities is things that can threaten the business in some way, like a debt or a supplier that needs to be paid off. Because we already heard the story before of, Miss Cynthia's boyfriend's dad forgot to pay off the supplier. So, this is the liabilities. And this is really important. This right here is really important. Alright? We forget this all the time. So this is current. Current means short term, which is basically quick. There's current assets, which is like money, which can be paid off and exchanged in like a short amount of time. You can just exchange it, And there's current liabilities, which is the liabilities that could be paid off in like a short amount of time, like an overdraft, for example, like an overdraft. And non-current assets is basically the assets that take so long to, get converted into money, like buildings and equipment. That's why the supplier thing. And non-current liabilities, which is the debts or the things that are like one year. Or it takes a long time to pay off, or like expect to be paid off in a long time. Let's move on. And now we go over to analysis of accounts. This is how you read all of this financial statement, income statement. This is how you read all of that. So analysis of account is how to interpret. It identifies the strengths and weaknesses for the strategy of the business. Like let's say the business is falling behind on some things. Maybe the financial statement will like give them like something to think about. Alright? And it shows the progress on objectives. Why? Because businesses have target objectives of how much money they could make within like a year or a month. And so this shows progresses on that objective. And then it shows them the correct steps to improve, because it will be clear to them once they've seen the statements and of the financial position. It will make it clear to them on what they need to improve on. And profit margin. So profit margin is actually how much profit we could gain from the revenue, essentially. So it's the formula is profit divided by revenue times 100. And there's also gross profit margin, which is gross profit divided by revenue times 100, which is how much gross profit we could get out of the revenue. And ROCE is basically how much bang you get for your buck. The return on capital is employed. How much money are you going to return when you use the capital? So it's profit divided by capital employed times 100. It's all in percents because it's a margin. And liquidity is selling the assets available. When your business has like a lot of liquidity, it means that it has a lot of current assets that are able to be sold. And who will need the financial statements? Investors, managers, because they want to see the objectives, of course. Trade payables, because they want to see if we can repay the debt. Lenders, same thing. They want to see if we can repay the debt. Government, they want to see if our business is eligible to be like, I don't know, given grants to. And the bank are also considered as lenders. And customers would like to know if we can make more products for them. And the owners and shareholders, they want to know if they will get the profit or if their business is doing well. That's why they need this, because they want to know. Alright? And so that's all for all this. So thank you guys. Bye.
Okay.